The Hang Seng currently trading 0.4% higher. The Taiwanese index too trading with gains of a similar quantum.
You were saying this is probably the biggest deal ever reached.
On daily charts, the next support comes in at 24,773. So it's down 0.25%, 24,785 on the Nifty.
The recovery in the rural, it has been excellent.
And most of the components right now, they are in the negatives.
In an AI automation world, we need fewer people. Fewer managers will be needed.
These are the kind of major big-ticket investments and commitments that the US and Donald Trump are seeking from India.
It has been that one-way fall on the Nifty currently.
Well, that is the day so far, and it's turning out to be a negative day. 160 odd points lower on the Nifty is what you have as things stand. I mean, Friday the market broke the previous low, and today we are basically down to the near-term. Actually, we've broken near-term supports as well. So, will the market find? Try to build some base around here. We'll talk about why that perhaps is the reason, especially from a futures and options perspective. Lots to talk about here in terms of single stocks as well. This is Closing Bell. We're coming to you from the CNBC-TV18 News Online studios. I'm Prashant Surabhi. Rima with me, guys. Good afternoon.
Hi, afternoon. The picture across globe is a lot better right now. I mean, look at Asia. Hang Seng closed with a gain of about 0.7%. The Korean market's up nearly 1%. Even in Europe, now that the deal is struck between EU and US, you've got some gains, initial gains at least, about 0.5% up on the CAC DAX and the FTSE. Perhaps the hope is we're closer to the end of the tariff-related uncertainty. The risk premium associated with the uncertainty is now ebbing. So there is green on the screen. But look at our own markets here. Look at the Midcap, Small Cap Index.
But Rima, that's not been a trajectory of only 1 or 2 days. That's been the story of the last month and a half. And I was looking at precisely this. If you look at the divergence between the S&P 500 and Nifty, in just the last 4 weeks, the S&P 500 has climbed 3.5%. Individual stocks are done even better. Nifty's down 3.5%. So the gap is over 6%, exactly. And of course, you have the trade optimism in Western markets, and then you have earnings. I mean, solid US earnings, right? Whereas we are dealing with the earnings issues, earnings casualties. Today's name, of course, would be Kotak Mahindra. We'll talk about that. SBI Card. Short point is that earnings, barring, of course, there are good names. I mean, Laurus would be a case in point. But these kind of stocks, big stocks, which when they come out with disappointments, something that was not penciled in, asset quality issues, it's a problem. And folks, I don't think we were going in with so much of asset quality concern in this quarter. Everyone was talking about margin compression. Market was prepared for that. But credit cost rising, asset quality becoming an issue, that's one more thing.
No, absolutely. And, not very much to go with on the positive side, right? I mean, lacking in triggers. I just want to quickly run you through what's lined up here over the next 60 minutes or so before we go any further. And then we'll sort of get to trades, F&O, etc. So the sell-off in Dalal Street, of course, intensifying a little bit. Nifty has failed to defend the crucial 24,700 level. Real estate, metals, private banks, the worst. We'll take stock of the setup in the final hour of trade. Stock-specific action, Laurus Labs, of course, is up about 5-6% the last I checked. We had the management with us, sounding quite bullish, actually. So that's something in a bit. IT Pack, right? I mean, down just less than 1%. It's already sold off quite a bit, but it's another sort of downtick here. So we'll talk about this in the context of course, the announcement over the weekend from TCS. And we'll sort of take stock of earnings, which will come later. Indocent, Gale, Bharat Electronics are some of those which we will get you previews for. So that's the lineup here as far as the programming is concerned, and the stocks that you will see us discussing. But we want to quickly get to the action, don't we? So let's get to Mitesh with what he wants you to do in terms of specific trades here. Mitesh, are we at that point where you start to turn a little bit, think about the other side, or not yet?
Good afternoon, Prashant. Not yet is my answer, purely because, look at the market. The market isn't showing any signs of turning around. Barring a few pharma names, I think the rest of the market, majority of it, is still showing signs of this corrective pullback, kind of continuing, marginally extending. I talked about the fact that we could test 24,900, and if we break below that, we could even test 24,500, 550 zone. So I still believe that that's a likely outcome. Around this 24,500 or levels, give and take a few points, a couple of weekly supports kind of kick in. So I think that is the zone, where you would want to at least reduce your short exposure, take some profits on the short side, and then see if there's a reversal happening on the hourly to hourly charts, which I think we are still, a few hundred points away from there. Having said that, on the stock side, I have one buy and one sell call. Dr. Reddy's, and I've talked about pharma as the positive setup. So Dr. Reddy's is a trading buy for me. Keep a stop below 1265, look for targets of around 1310. And on the short side is Adani Enterprises, which I would recommend selling with a stop at about 2550 for targets of around 2420.
Got that. This is going to be a big week globally in terms of earnings. 40% of the S&P 500 report earnings this week. They include tech giants like Apple, Amazon, Microsoft, Meta. You've got the Fed meet, and to end it all, you'll have the jobs data. And back home today, we've got earnings from BEL, Mazgao, IndusInd Bank will be tracked very closely, and Gale. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is now with us on the show. Mitesh, thank you for joining in with those trades. We'll come back to you. Gurmeet, first, Kotak Mahindra Bank, 7.5% gone now. I mean, were you taken by surprise? What is the advice? Did you hold it in your portfolio?
So, Rima, actually, they gave a very good Q1 update, and the stock ran up actually along with HDFC and Bank Nifty. And then Q1 earnings was a miss. So it's more of a bit of a reset if you see the movement in Kotak post the Q1 update. I think what slightly surprised the market was a larger than expected dip in NIMs. They were expecting about 20 bips. It came out to almost 30, 35 bips if my memory serves me right. Also, the credit cost marginally went up, which led to more provisionings also, especially in the CV portfolio and a little bit in the MFI portfolio. But I don't see any reasons for stress. Good banks tend to provision more. They've sold their general insurance business also some time back. So I don't think so there's a structural any issue there. It's just that the market was expecting, it's the positioning which was there, expecting a better set of numbers. But if you see the credit growth, it was about 14%, which is higher than the industry growth. Also, I think with more mobilization in saving, and maybe in a quarter down the line, even NIMs should stabilize. The NIMs in Kotak in that case anyways are much higher. It's above almost like 4.5 versus some of the other banks. So I don't see any reasons to be worried. Also, the stock is consolidated for long. Disclaimer, we don't hold Kotak in our portfolio. We have ICICI, HDFC, Federal amongst the private sector banks.
Okay, Gurmeet, just coming to you. Good afternoon. Just the F&O setup, right? And let's bring in Mangalam. For exactly that, are there any indications from the F&O side, data points, PCR, etc., which gives us a sense one way or the other? Mangalam, take it away.
Well, the indication is more of the other way than one. We aren't likely to see any sort of immediate up move. That's what the data is suggesting. Earlier there were indications of the market being oversold, and thereafter there could be some sort of recovery, and that's exactly happened in the first hour of trade as well. But thereafter, once those recoveries were sold into, the bulls have thrown in their towel, and that's exactly what we're seeing on the frontline index. The Nifty Bank, as well as the Midcap index, all of them lower, and the India VIX, which was factoring in complacency over the last two trading sessions, has seen a big spike now. From the lows, it's rallied almost 20-21% from the lows that we saw just before Friday. And broader markets as well. There too, we've seen some towel throwing coming in, because at around midday, we had 1,000 stocks advancing. That number has now fallen all the way to 600, and the number of stocks which were declining have crossed past that 2,200 mark as well, telling you that both the red and the green lines are the widest distance that they've been all through today's trading session. Earlier we also saw the 24,800 put see some writing, hoping for support come by around that 24,700 mark. But now if you look at the 24,800 put, positions are being unwound out there. The writers out there have been caught on the wrong side, and the open interest out there has come down as well. Importantly, the writing on the 24,800 call, 24,700 call continues unabandoned, and the 24,500 put writers are now finding some sort of action out there. So the street believes that maybe supports coming lower for the market from 24,800, 24,700 come down to around 24,500, and the put call ratio, which was already at the lower end of 0.7, has now come in at 0.6 as call writers have increased their positions and put writers are winding down some of their positions. So now the next important level, if the market fails to hold the 24,500 mark as well will be the 100-day moving average on the Nifty after having fallen from the 50 and the 20-day moving average. Amidst all of this, there are a couple of stocks which are seeing some amount of bidding. And we have Amber Enterprises. That's actually outperforming in an otherwise bleak market. Short positions out there are being unwound, so some short covering on that counter. But Laurus Labs and IEX, I'm keeping a very close watch on. Laurus Labs, in all probability, enters F&O ban today. And IEX as well, very close to the threshold level of entering F&O ban. So that's another stock we'll watch out for. Remember, IEX got out of the F&O ban just in the previous trading session.
Okay, absolutely. Need to keep an eye out on this one as well. Mangalam, thanks very much. And Laurus, definitely. We'll get the fundamental check on Laurus in just a bit. Stock's done very well after the numbers. Speaking of numbers, quite a few came out today and not inspiring much confidence. Actually, even where numbers are decent. For instance, Nippon Life, which is the mutual fund business, numbers were decent because you've got at least double-digit growth on the top line and the bottom line. And that's rare in a market like this. But the stock not doing too much, down about 1% or so. TTK Prestige was a weak set. Decline, top line, bottom line. Not a great quarter for TTK Prestige. Stocks down about 0.5%. But the two stocks that I want to put the spotlight on are from the defense space. And these are smaller private sector defense players. Zen Technologies and Paras Defense. Now, this is what the stocks have done after the numbers came out. Both have had a rough quarter. For Zen Technology, I mean, there's a major decline now. Year-on-year, revenue is down. Margins have compressed 300 basis points. For Paras, there is revenue growth, 11% revenue growth, but there's a margin compression of over 500 basis points. And given the rally, especially since April in many of these stocks, clearly the market is disappointed. Gurmeet, hi, good afternoon. You know, we always discuss this, and you're a specialist in this space, right? Having picked Solar Industries. So help us out here. I mean, a lot of people who would have bought these smaller private sector names going beyond the HALs of the world, they would be very confused, saying, should we hold on? This is just a one-quarter aberration. Or does it mean that this is too risky a space? What would you say?
So, Subi, it is tricky, and you got to probably, and it's a very technical business, and you do need to understand the lumpiness of the business because it's dependent on government orders and export orders. Zen Technologies, in this case, I think the subsidiary saved them the blushes, otherwise the numbers could have been even softer. I think what they have mentioned is that they will, over 3 years, they will do 6,000 crore stock. And that is where you can't take it quarter on quarter, right? So recently they got one more patent and then the stock ran up. And, the stock moves like this. When it went down from 2,500 to 1,100, we kept seeing lower circuits of 5%. And then from 1,100 to 1,900 also was 6-7 days of 5%. Okay, but, to their credit, they have 23, 24 patents. Because of the emergency procurement by the government in army, the normal orders, there is a bit of a delay. I think, the second half could be better. Also in simulators, which is where the biggest market is, they have 100%. They have 100% market share there. So as more orders come up, they should do well. And they're doing a lot of stuff in the anti-drone system as well. Have about 24 patents, if I'm not wrong, one of the highest in Indian companies. So you have to live with this volatility. You have to, look at and see what it has done in the last 3-4 years and not see it on a daily basis.
So you'll be a buyer of the dip. So Zen is a thumbs up. What about Paras?
Paras we don't have in the portfolio. So we have Solar, we have Zen, we have Bharat Electronics, and we have small exposure in HAL now. See, India is down to now 29 squadrons. We need like 43 in case tomorrow if we have a three-way war. And once this engine issues get resolved, you will see, massive order book playing out. Also now 60% of the revenue comes from service and repairs. So that also gives you some kind of stability and not as much as lumpy as some of the other businesses are.
Okay, so Solar, BEL, Zen, and a little bit of HAL. That's your defense portfolio right now.
I just want to say one thing. I just went back. Surabhi, if you remember, the first show on Editor's Playbook was defense, right?
The defense opportunity.
So I just went back and looked at where we did it, right? We did it on the 15th of May.
It was just after Operation Sindoor, I think.
Yeah, so 15th of May.
Yeah.
Guess what? The Nifty Defense Index, from that point, had a nice... not a very large rally, but it sort of, because there was a phase when things were going well and all the beaten down names like Idea Forge, which had for years done nothing, they were all coming back.
Correct. Yeah.
We are exactly back at it's like a round trip. We're back at the 15th of May levels. The short point being that I think, and we were making that point back then, that, news flow and everything is one thing, but when you're buying stocks, you have to be careful about what you pay.
Yeah.
Because otherwise you get carried away, right? In terms of in terms of what you will pay. It's like rising tide lifting all boats, but not boats are equal in that sense. So I think it's important. Even something like an Idea Forge. I mean, I'm surprised. I'm looking at this now because I thought it rallied quite hard. I mean, from 360, 370 levels, just had a one-way move to about 650. It's back to 450. From 650
fizzled out very quickly for
650 to 450.
Yeah.
You know, so yeah, I mean. So you got to be mindful and be careful of what you pay. Otherwise, especially when you have this a little bit of a frenzy, momentum, you buy something and then you're stuck. Then you don't know. You're waiting for they probably wait a while for you to sort of get your price back. It doesn't apply only to defense, it applies to everything. But I just thought make a quick point. Laurus is the one that Reema was going to. So let's just focus on that a little bit. Stocks up about 5.5%. Let's get the details of the results first with Ekta, who will play out the sound bites.
Well, yes, Laurus Labs, the guidance in the conference call has been quite encouraging post the numbers that came out during market hours on Friday. So they've said that the CDMO revenue is expected to grow from the current 30% to potentially 50% of revenues in the medium term. CDMO revenue is expected to be around 2,000 crores for FY26. Gross margins could possibly expand to around 55 to 60% in coming quarters. They did not provide a quantitative top-line guidance for FY26, but they've said that they've laid the strong foundations for FY26 and beyond, and they expect margins to improve in FY26. Goldman Sachs has a sell, but they've raised their target price to 675. Jefferies as well underperformed, raised the target price to 590, and Kotak Institutional has raised their target price to 555 and have a sell rating on the stock. In fact, let's listen into what the management had to tell us earlier today.
Our gross margins were always between 55, 57 in the previous quarter. This quarter, because of higher revenue contribution coming from CDMO, the margins were over 59% now. Looking at the prospects, what we have, and we estimate the gross margins will remain between 55 to 60%. Primarily because of higher contribution coming from non-ARV and also increasing revenue share coming from CDMO. In 2021 financial year, our revenues of CDMO was 500 crores. Now we were able to move towards 500 crores per quarter. And we estimate the run rate looking good. As you are aware, CDMO business is bumpy, but for the entire year, we expect the CDMO revenue contribution will be over 30% for the entire year.
What a move in Laurus Labs. This year itself, Gurmeet, stock is up nearly about 48% now on a year-to-date basis. Your thoughts?
So we continue to hold, Reema. So I've seen 70 to 700, then back to 250. Now a new high almost made today at 900. Again, very lumpy business. And I think in between they did heavy capex, and that did not come off the way they guided, and that led to severe underperformance in the entire bull market of 22-23. Laurus did not participate. And now once you have molecules getting commercialized, if you see the numbers of export month on month, June was almost 107 million. And now they've also got a big land allotted by Andhra government, where they've committed heavy capex, more capex than they've done probably in the last 10, 15 years or next 4 or 5 years. I think that is also one trigger for the stock to work, and promising employment also. So I think their chemistry skills, their ability in CDMO in terms of late life cycle strategies and I've been saying this for a while, that CDMO is where IT outsourcing was in 90s. And I think there's a huge opportunity once the Biosecure Act, if it gets passed and sees some light at the end of the day. I think a lot of our companies can do well. Catalent, Lonza, some of the Chinese companies do $6, $7, $8 billion top line. The largest one in our case does what, 600-700 million, which is Divis. So Laurus is already talking of 500 crores CDMO per quarter, which will what, 2,000 crores for the year. Still a fraction of what the global market is. So I think there is an opportunity here. But obviously, as I said, it is a lumpy business, and players like CDMO, defense, you got to size your bets well, diversify it, don't go overboard in terms of having 10-15% weight in the portfolio, and have a 4 or 5 year view in terms of the R&D they are doing and what will pay out. It's extremely important not to chase momentum here.
You liken the CDMO opportunity to Indian outsourcing in the 1990s. Well, Indian IT outsourcing, the penetration, the arbitrage was very promising. But now in the age of AI, all that is getting questioned. And TCS's news flow over the weekend really rattled and shook sentiment. 2% of workforce on their base of 6 lakh plus. We're talking about 12,000. And TCS isn't alone. You know, even HCL Tech, and I think that news sort of got missed, but HCL Tech also clearly spoke about people and non-people, facility restructuring, which will play out in FY26. They didn't give any details, but they specifically said we will have people restructuring also in FY26. So clearly tough times. Global giants have already announced, job cuts, and they have been for the last 1 or 2 years, but now it's hit closer home. What have you made of all the, news flow? And, is just this the start? And we are going to see aggressive headcount cuts. And how will the investors react to this?
Obviously, they haven't done as much R&D as they should have, considering the cash balances most of our large IT services companies had. But there have been exceptions. There have been exceptions in mid-cap IT, especially Persistent, Coforge, maybe KPIT to an extent. In general, now we are hit with an auto slowdown, but maybe with the trade deal with the EU and US, where EU talks of only 2.5% import duty to US, it might be just good news for KPIT and auto, as a sector as a whole. I think some of the bad news is in the price. If you see the price action over a period of time, and we should not write off Indian IT services companies. I think we've made this mistake so many times. But AI is a bit of a genie out of the bottle. So we'll see how it goes. But I think we have the ability to pivot and really contribute towards it. They have the cash balances. There is a realization there. But for now, I think it's better to be slightly underweight there. Maybe tactical bounce can happen once the trade deal happens, or there is a some positive news flow order base. In our case, we are less than 5% in IT services. We have HCL Tech amongst large cap. And we are looking at adding in case we get better price points between Persistent and Coforge.
Okay. Got that. Gurmeet, come on, time for a new name.
Nothing new, Prashant. We've been, as I said, researching I think one space which has been out of favor has been chemicals, under-owned. 2-3 years of inventory destocking, price points. So we added JG Chemicals, which is into zinc dioxide and recycling of zinc. The end use is tire, and now they're expanding the end use to ceramics, specialty chemicals, pharma. That's done very well for us. We added at around 350 odd levels, so it did do well, and now there's a bit of a retraction happening. We are looking at some tactical plays in refinery space, considering the valuations. A lot of them are now. Some of them are like half of replacement cost, or maybe 1/3 of replacement cost. And with I think inventory losses behind you, shutdowns behind you, diesel cracks improving, you might see very good, GRMs and sudden bump in profitability. Those are more tactical in nature. And we are, as I said, looking at some more opportunities in the recycling space. That's one space I really like. We call it a circular economy. And I think that's something where the market size is too small. So we are looking at increasing weightage in the likes of Vatek, Ganesha, Gravita, and some of the other names.
Okay. All right, Gurmeet, we'll leave it on that note. Thank you very much for joining in and giving us perspective. Quite helpful in times like these. We do have to take a very quick break. Market, well, still nursing a cut of about 150 points on the Nifty. Midcap index still down over 400 points. Take a break. We'll get some perspective going with Nitin Bhasin, Head of Institutional Equities at Ambit, as we get through what has been so far a disappointing Q1.
Welcome back. The Nifty below 24,700, 150 points gone in the benchmark. Sensex down 550 points. What about individual stocks? Hormus is here to put the spotlight on mid caps and small caps.
There are plenty of movers within the broader markets today, and some of them are earnings reactions, some of them not so. But we'll start off with Paras Defense that came out with results on Friday. In response to that, the stock was down 3%. And today, the stock has seen a 10% knock as well. And that is the biggest single-day fall that the stock has seen since June 2024. And now with this fall, it is moving towards its 100-day moving average of 684. And this is also down now 30% from the 52-week high that it had just made in the month of May. So within the next 2 months, the stock has corrected 30% from those levels. Another earnings reaction which came out last week and since then has been sulking is DAM Capital. Another 7% knocked off in today's session. It's down 12% in the last 3 sessions. Now already trading below its IPO price, but it has already halved from its post-listing highs, which were well over 450 rupees. So continuing to see some value erosion, and since the 17th of July, the stock has gained only once. Northern Arc Capital is the other one. That too has taken a big knock in today's trading session. Another 7% gone today. It's the 5th straight day of losses, down 13% in the last 5 trading sessions. And even this stock now trades below its IPO price of 263. Now the fall here in Northern Arc Capital comes on lower volumes, which are less than its 20-day average in today's session. On the positive side though, Cartwright Tech came out with numbers earlier today. The stock saw a bit of a dip and then has seen a one-way move on the upside, 10.5% higher on that stock. It was a very strong recovery that the stock had post-earnings, and this was one of the biggest underperformers in terms of the new age companies until March of 2023 when it made a low of 350 rupees. The IPO price is 1600, and since those levels, the stock is up almost 6x, and today it's traded almost 40 lakh shares compared to the 20-day average of just 3 lakh shares. And lastly, JK Paper is one of them. At one point, paper stocks, everybody spoke about them, but today the stock is down almost 5%, down 6 in the last 7 sessions. And the last 3 years, the stock has had negative returns, even you compare in absolute terms. And this is after gaining 90% each in 2021 and 2022 as well. So plenty of movers on the downside, some of them trading on lower volumes despite seeing a big knock in today's session.
Right, Hormus, thanks very much for that. So that is the unusual movers pack with Hormus as always. Nitin Bhasin is with us, head of institutional equities at Ambit. Nitin, good afternoon. Good to have you with us here. Thanks very much. I mean, I think the big talking point is, of course, what's happened with the IT services, and Rima has been covering that for us. And Surabhi was reminding me that you had a bit of you were constructive on IT, Nitin?
Yes.
Back in March, you still hold that view after the result season? Maybe too late to sell, but I mean, do you think it'll make money from here?
I think you're right. For the last month and a half or so, our strategy call was to go underweight on banks and perhaps increase weightages on IT. Hasn't worked out. In the last 1 month, IT sector has underperformed the bank nifty by about 5 or 6 percentage points. I think clearly that's what the past is. However, we are continuing to see that there is more risk building up on the credit in India in terms of credit growth, in terms of NIM margins, etc. So we believe that if you were to take a little longer view of 3 to 6 months, our view for the midterm for our investors, institutional investors, is from here on perhaps to not that much of risk of FY26 earnings estimates, at least for the large caps in the IT sector.
But Nitin, I mean, just elaborate on that call, because earnings estimates anyway, they're so feeble, right? We're talking 0 to best case 3-4% growth. So what is the view? I mean, is it just going to be a play on the cash, maybe better buybacks and dividends? Or is it that you're bearish on other parts of the market? Like you mentioned, banking. So I'm sure the call is in tandem with the other tactical allocation. So just elaborate on that. And also the negative view that you have banks, that's turning out to be, absolutely spot on, at least just looking at short-term earnings. I mean, first quarter has been really disappointing. Barring HDFC and ICICI Bank, most others have disappointed, either on margins or on asset quality or both.
So, fair point. I think what we've been highlighting is that we are into the fiscal year in which the flows are reducing because of the last 12 months of Nifty performance or funds performance, because of which, and entering into a fiscal year where the earning estimates are very feeble. Again, remember, the whole Nifty is not supposed to grow earnings more than about, let's say today, 8 or 9%, which is not any different from about one quarter back, 9 or 10%. So in a market environment where flows are perhaps reducing, number two, where the earning estimates are very, very frail or feeble or low numbers, where do you actually go and park your money? We've seen such cycles in India in the last 15, 17 years twice play out for about 2.5, 3 years, where market has increased in concentration, and which profits start becoming concentrated. And hence, the three sectors which have performed in each of those two cycles in the past, when we've had that in 2010 to 13, or let's say between 17 to 20, what we've seen is IT, FMCG, and pharma have historically, delivered or outperformed the market. That could be one of the reasons that we have in saying that where the market moves, perhaps for the next 6 months or 12 months or slightly even longer. We've already seen market move sideways for the last now 9-10 months. Where do you go and lose less money? Perhaps that was the call. FMCG, pharma, which includes healthcare also, plus now IT. So that was one of the larger thinking behind this call. In the near term, what we said was the IT sector has seen a lot of downward revisions in the last couple of weeks or 3 weeks. And with that behind us, we thought that it's right time to add IT, but clearly hasn't worked out. But we said banks would actually go through more downgrades. It could continue in June as well as in September quarter.
So Nitin, the call is in the second half of the year, things get really tough for the Indian markets. We're in for a correction.
So clearly, I don't know about the market correction. We've seen periods in the past where we have seen markets move sideways, not generating more than about 2 to 4% CAGR or -2 to -4% CAGR. Because what are we looking for? We're looking for flows to pick up in India with a considerable trend, or we're looking for earnings trajectory to actually recover. Clearly today, FY27 earnings may be looking buoyant, but FY26 earnings clearly aren't looking buoyant. And if you look at the flows also, last one quarter may be good or 1 month may be good for domestics. But again, FIs have turned sellers in the last 1 week or fortnight. And what we see is pretty much a very unpredictable or not a very secular trend of flows. So hence, where earnings visibility is, at best, high single digits or perhaps, low single digits or mid single digits, and flows moderating, I don't see markets going considerably to higher levels. It could oscillate for the next 6 months to 9 months also.
Speaking of earnings, that's a big top line miss for BEL. It's a wide miss, almost 600 crores of a miss. Though profits are fine, maybe at the top line it could be some spillover effects, some orders moving in, maybe to the next quarter. The revenue estimate that we were working with was around 4,800 crores. The company's done, far lesser than that. Though the EBITDA line and the margin line is not too bad. And that explains why the stock perhaps is holding up. In fact, they announced an order. BEL, in fact, just over the weekend announced a big order. It was a 2,000 crore rupee order. So that's what I'm saying. I'm not sure if that was expected to be accounted for in Q1 and spilled over to Q2. But anyway, that's BEL and stock is in focus. We'll get you more on the earnings in just a bit. On earnings, Nitin, hearing you out, we started the year with everybody telling us FY25 was bad. We had 5-6% earnings growth. On that low base, 12-13% to ho jayega. But will it happen? Do you see those numbers come through for the full year?
I think I've shared this before as well, that if you look at the last 15 years in India, every time we start the year at about 18-19% earnings growth expectations, and we moderate ourselves down to 11-12%. Perhaps that's the signs of optimism every country or every market faces from the sell-side analysts. This year around, we started the year with about 10 or 11% earnings growth. And we've already come down to closer to about 8 or 9% earnings growth. Last I checked was that mid-caps and small caps have done slightly better than the Nifty earnings for this year. This quarter, with about 24 odd companies announced numbers. We're only up about 5% PAT growth as compared to 7% last year and 12% the quarter before. So I think earnings growth, as I said in the beginning, we're looking for, market always looks for, I think, earnings or looks for event or it looks for flows. Clearly, earnings are not playing out, flows are moderating. The event which is coming up to all of us is perhaps the festive season. And we all know that the consumption trends are again volatile. So the market will start looking at the trends of consumption going into the festival season. That information will start dominating the market moves or gyrations in the near term.
Nitin, just a quick word. So the big sector calls are you're bullish on tech, pharma, consumer, and you're negative underweight on banks. What about some of the smaller, themes like platform companies, quick commerce, or real estate, defense, realty, cement? What about, just quickly take us through the overweights and underweights here?
Sure. We've spoken about this, that as the market moves sideways, or perhaps it's very difficult to find trend-like behaviors in one particular index or otherwise. It's a stock pickers market. We've maintained that for the last 6-9 months. And you can see that stocks wherein the FIs came in the last 3 months, whether it was heavyweight such as Bharti, Reliance, an ICICI Bank, or an HDFC, those stocks performed really well. Whereas, where they sold, perhaps they didn't do that much well, whether it's an SBI or Infosys. So I would not hazard a guess at a single sector, a single theme, barring those 3 sectors which you mentioned, overweight, an FMCG, or healthcare/IT, I would say in the near term. But again, in that you'll have to be selective. So let's say even in IT, why should one be actually thinking of TCS? And why not things such as relatively inexpensive, can't actually see more downgrades like TechM, Infosys, or Cognizant? Those would be the ones. So I think we'll have to see what stocks, defense, etc. We aren't finding them to be any, beyond a theme right now. Hence, we would advise staying away from thematic, but more focusing on quality of companies.
Okay, and next time we will talk about specific companies because I think you sort of have a decent small mid-cap coverage universe as well. And on the back of earnings, I was noticing some upgrades, some earnings cuts, and so that kind of action as well. So we'll talk about that. For now, thanks very much, Nitin, for coming on as always here. Appreciate your time. BEL is not really moving very much. It's down 1.5%, 1240 EBITDA compared to a poll of about 1180 odd crores. So at an operating level, numbers are just fine. Margins actually are much better, almost about 350 basis points better than expectations. Take a break. Back with D Street Chatter with Nimesh. He tells us, of course, a sense of what he's picking up out there. Of course, a list of stocks he's watching, and we'll get you some trades as well. Stay tuned.
Welcome back. So the market is still nursing, a cut. The good news is that we're not at the lowest level for the Nifty, and at least it's not making lower lows. But let's see, still not very, very inspiring. And of course, a bigger problem in the mid-cap market with the mid-cap index down almost 1%. Nimesh is joining in with D Street Chatter. Nimesh, red is the color this Monday. What have you been hearing? Dealing room?
Hi, Surbhi. It's largely a down day, dragged by a few individual sectors like financials, technology. These are the 2 large sectors, and because of tech, there is a bit of a second layer impact on the real estate names as well today. So the real estate index itself is also down more than 1.5%. So clearly, these are the 3 sectors which is dragging the overall markets down. But from a flow perspective, my sense is it's more of lack of buying than aggressive selling from the larger institutions. So the FI and DI data could be interesting to watch out. But at least my sense is there is no large selling is what I can understand or get a feedback from. There is very sharp reactions to earnings, and that's the trend which is likely to continue. We saw today what happened to Kotak Bank, or a small disappointment, down 7%, and the other side, Laurus is up as well. So these individual stock reactions on earnings is likely to continue in the very near term. Technically, 24,450 is the level to watch now on the downside. That's a very strong support on the Nifty. So let's see if if you hold on to those levels, we're still a few 100 points away. And also the PCR after such a fall has come to 0.65 levels. And generally, we've seen a bit of a pullback from those levels. So a pullback could be on the cards, but from a flow perspective, it's lack of buying rather than aggressive selling from larger FIs.
You're seeing sharp reactions to earnings, as you pointed out, on both sides, on the way down, on the way up. Cartrade Tech, Sudarshan Chemicals, Acme, Aadhar Housing Finance, Laurus Labs. What big moves. What about stocks, Nimesh? What have you picked up?
Well, so the first stock on my list is Marksans Pharma. There was a large block, 2.3% equity got changed hands. I understand it was a clean-out trade from an FPI investor of Marksans Pharma. So looks like some domestic funds were buyers. So disclosures would be quite interesting. But from a seller perspective, my sense is it's a large FDI investor who sold out completely today. So that's the first name. The second stock is Godrej Properties. I spoke about real estate under pressure in general, but Godrej Properties stands out on back of very strong selling. And also additionally, I understand there could be a large block in Godrej Properties very soon. Remember, last week also a large FI sold out, and another large FI investor could be a potential seller in a block in Godrej Properties. So that's the second name. The third stock is Bharti Airtel. Even that's under pressure today. Aggressive selling is what I understand, and one long only fund seems to be an active seller in Bharti Airtel at current level. So that's the third name. And the last is a couple of stocks where I'm anticipating large block deals very soon. Paytm, Emphasis, as well as Flair Industries. In Paytm and in Emphasis, there are strategic investors who could be potential sellers. And in Flair Industries, the promoter entity could be a likely seller. So expect large blocks in these three names in the days to come.
Okay, all right, got it. Thanks very much, Nimesh, for all the buzz and the chatter. By the way, I just want to point out one stock, which is Bajaj Finance. Pull up the intraday chart. The market's been weak throughout, so was Bajaj Finance. But now it's picked up momentum, a lot of momentum on the way down. It's the second worst performing stock on the Nifty. Look at that, 4% down on Bajaj Finance. That's not a small cut. After Kotak, it's the next worst performing stock on the Nifty. We had Digant Haria on our news show with Nigel just a while back discussing banks and NBFCs. His point was that Bajaj is not present in the online space. Online, electronic sales. That is where there are other financiers, and it's traditional bastion of retail consumer finance that's getting challenged. That was one view, but anyway, this is a big decline on Bajaj. A good time to bring in Mitesh as well. Mitesh, just throw in a word on these big financials which are falling before you get to your calls. Kotak, no respite, and this Bajaj 4% drop. What do you make of it?
Kotak, I think, I talked about that in the morning that 1940 is the 200 average area. We should possibly head there. We're not very far away from there. Once it breaks that, then there's a good chance of it happening. I am even looking at a test of around 1880. So the structures turn weak for Kotak with this kind of a big fall. And similarly, I think, Bajaj Finance, the correction started, I think, yesterday, but rather on Friday. And now it's, nearing the support level. So Bajaj Finance for me, 873 to about 864 is the medium-term support area. We might not break it in the first chance and therefore get a bounce back. But I believe that the structure is weaker. So I think if you get prices around 900, 915 zones, I think that will be good levels to possibly for the short-term traders, good levels to exit.
What about any other trading ideas?
On the stock side, I have sell on STBT on Havells with a stop at about 1510. Target around 1495 can be looked at. And the other stock is STBT on Hind Copper with a stop at 250 for targets of 242.
Okay, got that. By the way, Mitesh, just one more stock, IndusInd Bank. Obviously, it's just ahead of numbers. Stocks at days low now. Just levels to watch on IndusInd?
See, the entire banking pack, post the Kotak numbers are coming to pressure, and IndusInd Bank had started correcting few days back itself. The first level is around 765. So there's still about 4-5% trading downside left. In case you break that, and there's a good chance of that happening, I'm even looking at 725, 730 being tested.
Okay, all right. Sudarshan Chemicals is something we want to talk about. Mitesh, thank you for that. It's up sharply. Some 15% or so. Now, they reported numbers, but mind you, not for the first quarter. Okay, it's coming off as we speak, 6%, 7%. So it's not reported numbers for Q1 the earnings season that we are reporting on, but they report numbers for the fourth quarter. Sonal has got more. Sonal.
Well, do remember, Sudarshan Chemicals is surging in trade, but it is the Q4 FY25 earning that the company has reported. This is after the UBAC consolidation or the acquisition which was completed in the month of March. The company has said in its notes that Q4 FY25 numbers are not comparable to any other quarter. So that's why if we look at the revenue number, it looks quite elevated. So it's a growth of 76% on a YY basis for Sudarshan Chemicals in Q4. However, EBITDA is down this time around because costs related to the acquisition, they have shot up. That's why EBITDA looks lower. There is a profit element of just 31 lakhs, which compares with 58 crore rupees. There is an exceptional expense to the tune of 61 crore rupees. There are various adjustments that the company has made because of this acquisition, a huge acquisition that the company had made. So remember, this is not on the back of Q1 numbers that the stock is surging. We are still awaiting Q1 numbers for Sudarshan Chemicals, and that is something which will have more numbers from the acquired entity and also the outlook going forward for the pigments business. So that is something which will be important to track.
Okay. All right, Sonal, thank you very much for that. At least some green on an otherwise red-looking screen. Let's go back and look at IndusInd now. We just got a technical check with Mitesh, but let's prep you up for the numbers which are slated to be released today. Gaurav is with us. Gaurav, tell us, what's the expectation?
Well, when it comes to expectation for IndusInd Bank, we have already seen in the provisional update, the loan book has declined almost by 3%. So the weakness is definitely there. And as a result, they are expecting weakness in the results as well. So net interest income, it is expected to go down almost by 22% on a year-on-year basis. For net interest margin specifically, in the last quarter, there was a one-off impact. So on a reported basis, they may increase almost by 100 basis points. So they are expected to come somewhere in the range of 3.2%. But at a normalized basis, if we compare on a sequential basis, they are expected to go down almost by 20 to 25 basis points. Another point to highlight here is that the operating profit, that is likely to decline almost by 40% because there won't be any kind of push from the other income as well. When it comes to the credit cost and overall asset quality, now we are not expecting any kind of negative surprise here, at least in this quarter. We have seen elevated credit costs for the last quarter as well as slippages. So we are expecting some kind of easing in the credit cost as well as slippages, but they are still likely to remain elevated somewhere in the range of 1.8 to 1.9%. When it comes to profit, now brokerages are expecting profit to decline almost by 70 to 75%. Now this is because of the one-off impact that we saw in the last quarter and also because of the weakness in the loan book that the bank has shown for the last few quarters. When it comes to some things to watch out for, first is that the growth in net interest margin and the trajectory, how they are going to call out for the trajectory of net interest margins is something which is a key thing to watch out for. Second is that MFI asset quality, and third is the growth trajectory going ahead in terms of the asset size as well. So definitely we are watching out on the IndusInd Bank, but at least for this quarter we are expecting weak set of numbers.
Okay, all right, Gaurav, got that. Thanks very much. So waiting by for IndusInd Bank's Q1 report card. Also waiting by for GAIL's report card, actually. Let's go back to Sonal to get the expectations laid out. Sonal?
Well, GAIL is expected to report numbers, and there will be a sequential decline in the revenues this time around of 3.3% to come in at 34,474 crore rupees. EBITDA, however, is expected to increase by 5.5%, margins at 9.8%. Profits, however, will see a decline of 3.5%. Well, let's talk about the segments first, because this time around, the transmission, petchem, LPG businesses, all of them are expected to remain weak. In fact, the losses in petchem is expected to widen this time. Kotak has put out some estimates. They expect gas transmission volumes to decline 7% YOY, but they will be up 1% sequentially. Petchem sales volumes will be flat YOY, decline 26% on a quarter-on-quarter basis. LPG sales will also be up 3.5% quarter-on-quarter, but they will be down 6% on a YOY basis. And marketing EBIT will come at 1,250 crore rupees, which will be a decline both on a quarter-on-quarter and on a YOY basis.
Thank you, Sonal, for that. Get into a break. A quick small programming note for all our viewers. As the workplace transforms, so must leadership. In the Bengaluru edition of Future Female Forward Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on the 29th of July, 5:30 p.m. onwards, only on CNBC-TV18, CNBC-TV18.com and YouTube. Welcome back. Counting down to today's trading session. It's been a challenging start to the trading week. The Nifty is below 24,700. The pain is more acute in the mid and the small caps, and the advanced decline ratio is negative now for the 7th consecutive day, firmly in favor of more declining stocks, 1:3 in terms of advanced decline. Dharmesh Kant from Chola Securities is now with us. Dharmesh, afternoon. Lots of mid-caps are bucking the trend. There's Acme Solar, Sterlite Tech, Laurus Laboratories. Any of these stocks that you like, or which one has been the pick of from the earnings season in the last couple of days?
Yeah, Dr. Rima. I mean, see, earnings have been all over the places in this season around, and chemicals is one sector which, I mean, the performance has been far better than the other sectors. Cement, chemicals, metals, they have done pretty well. Today's earnings, be it Laurus Labs, I take it with a pinch of salt, because the reason being earlier also the management has guided strongly, but last 3 years there have been many misses, then hits on that front. And look at the valuation multiple, it's at around 92, 93 times trading PE multiple, which is they are trading at. So to my mind, I mean, CDMO business is fine, but scaling back up to 32 kind of a margin would be difficult for that. And going by the valuation multiples, it's time to take profits. So that is the take. The earnings spec which I liked was more to do with the chemical space where things are happening. Maybe Ether Industries is one company which one should look into, which posted a good set of numbers. And in independent power producers, one should be looking into NTPC Green Energy earnings. It's due, and the capacity additions for this year would be around 5 to 6 gigawatt, sorry. And that would be entail a huge amount of profitability going forward. We have seen the proof of the pudding in the other independent energy producers, which they have given the numbers and how capacity addition helps in the earnings growth. So NTPC Green is what we are banking on. Let the earnings come through, and then further we can take a call on that.
BEL just reported numbers, and EBITDA margins and bottom line looks pretty solid, even though on the top line I think there's about a 7-8% miss. Dharmesh, any thoughts? Bharat Electronics?
Yeah, Dr. Bashar. Yeah, the numbers were okay type of numbers with better EBITDA margins. But when we are looking at defense companies, one should not be looking on quarterly basis. That is my sense. Because if you look at the 13, 14 listed companies, all put together post a revenue of around 68,000 to 70,000 odd crores. Whereas the order book stands as in excess of 3 lakh odd crores. So more, the visibility of order book is 4 to 5x, and these are basically lumpy businesses, not cyclical in nature. And there are a few years where you will have a good round of, revenue booking and profitability coming into play. So any declines out there for a company like BEL or HAL, we are recommending to acclimate on every declines, and the horizon should be 3 to 5 years kind of a perspective, because the opportunity size is very large. It will entail over a period of time. But as of now, because quarter to quarter, the kind of value traders may be booking profit, and they are the ones who also carry the stock prices forward. So stay invested in both BEL and HAL. Defense looks pretty attractive to us.
What are you advising on Kotak Mahindra Bank post the numbers?
Yeah, Rima, the difficulty with the large banks and the large IT companies has been they have been very candid about the growth and trajectory and the atmosphere prevailing into the economy. And Kotak Mahindra Bank, the basic problem has been the guidance for, in fact, Q2, the retail and the two-wheeler, three-wheeler division, which is basically a small ticket size of loan, and they have cited that there's a problem out there. So it's still valuation is expensive, around 2.3 times price to book value at current price. I think some more downside out there, and one has to wait for Q2 to pan out before taking a jump into financials, because it's not only Kotak Bank which has guided for a weak set of retail credit growth. It's across the board we are finding the same kind of synergy. So financials are barometer of the economy. So let's wait and see rather than jumping the gun and buying it out right now.
Okay, all right. Dharmesh, stay with us. We're going to just wrap out things here, and then we'll come back to you on markets forward. So you've got the indices all lower, varying degrees, 0.5%, about 1.25% lower, Nifty Bank, small cap, mid cap indices. But apart from that, not very much at all. So a drifty lower day. Market breadth, of course, clearly on the negative side, some 3:1 over 3:1, declines to advances on the NSE is what you had. So it was on the downside. If you look at the Nifty, it was a bunch of financials, right? So Kotak Bank and Bajaj Finance, IndusInd Bank on the Nifty were the top losers. Outside of Nifty, SBI Card was the big loser. On the large caps, the IT names were the other pack, which were lower. TCS, HCL Tech. Wipro, of course, was down about 3.5%, 4% as well. And of course, I mean, real estate as a pack did not help either. I think as a index, the Nifty Real Estate Index was the top loser. Lodha was down sharply, Godrej Properties and a few more as well. So enough moving, but it was largely on the downside, continuing the downside that we've seen develop over the last couple of weeks or so. Rima.
Well, with that, it's curtains down on closing bell. But since the IT industry is in the spotlight in the new age of AI and so much business disruption, you'd want to listen in to this next show. It's our special show, Editor's Playbook, where we will discuss India's IT industry that is at a crossroad. Will the AI age force a change? Coming up next.